Good morning. It's Monday, the 24th of March, and this is Govindraj Ethiraj, headquartered in broadcasting and streaming from a warm Mumbai, India's financial capital. The take. Trump talks tough on trade, but the McDonald's example says otherwise. US President Donald Trump's favorite McDonald's order is believed to be 2 Big Macs, 2 Filet-O-Fish sandwiches, and a large chocolate shake malted. On some days, he even starts his day with McDonald's, and there are reports dating back several years documenting his fondness for burgers at all times of the day. There are many photographs as well, most recently after he won the 2024 US elections, of him wolfing down a McDonald's meal with friends and aides aboard his private jet. Arguably, as President of the United States, he's done more for the McDonald's brand consistently than perhaps even for Tesla, despite the unusually grand White House endorsement he gave the electric car and Elon Musk. Now, in case you missed it, McDonald's announced last week its formal entry into India's Global Capability Center space, its largest such investment outside the US. GCCs are captive arms of multinational companies handling increasingly complex operations across the value chain, from drug research and development to chip design and core business processes. McDonald's was not a silent entry by any stretch. McDonald's chairman and CEO Christopher Kempinski, a former Procter & Gamble and Kraft Foods veteran, arrived in Hyderabad and met with Chief Minister Anumula Revanth Reddy. According to reports, he even explained why McDonald's chose Hyderabad over other cities. Kempinski was accompanied by top McDonald's brass and said they were exploring ways to step up sourcing from Indian farmers for both domestic and international markets. McDonald's announced that it would occupy a large facility in Hyderabad and employ close to 2,000 people and develop it into a skilling hub. McDonald's, by the way, has a long-standing presence in India, close to 30 years old, and about 600 stores across India. Now, McDonald's setting up of that GCC, which obviously feeds global operations in India, is worth viewing in the context of the upcoming tariff war expected to start on the 2nd of April. It does appear that while negotiations are ongoing and officials on both sides continue them, there seems to be a mild thaw in the tension, at least as far as India goes. Trump separately has said he will be flexible last week, though he did not define that. India is expected to concede on select tariff lines, including whiskey, superbikes, and maybe California almonds. Now, the interesting thing is that despite President Trump's repeated threats, India may be closer to a trade compromise with the United States than many other countries, largely because it's already started reducing in tariffs in sectors of interest to the United States and has not so far demonstrated a confrontationist approach. But to go back to McDonald's, they're not alone. In February, Google announced the opening of one of the largest offices in Bangalore called Ananta, spread across 1.6 million square feet and meant to house about 5,000 employees. While work on that facility would have obviously begun a while ago, that's exactly the point, as we've been arguing on the core report. Corporate America's fortunes are deeply intertwined with Indian talent, and increasingly that talent sits right here in India. There are now over 1,700 global capability centers, like the one McDonald's is bringing in and setting up, employing more than 1.5 million people, mostly in high-skilled roles. An estimated 70% of those employees work for American companies. And then there is the work that Indian IT majors, including the Wipro, Infosys, and TCS do. Indian IT exports stood around $200 billion last year, of which 60% was to the US. So you can see the interlocking there too. Last week, Cisco CEO Chuck Robbins told CNBC that the Trump administration wants American companies to win. He said that they want to protect the lead that American companies have and win the artificial intelligence race. So, if Trump wants American companies to win, then it is worth pondering, once again, what explains their winning so far and what lines might they cross, or which lines will they not cross. For context, Cisco, the $54 billion tech giant, started operations in India in 1995, employs around 15,000 people, and runs one of its largest development centers outside the United States here. Yes, you got it right. Both McDonald's and Cisco came to India at roughly the same time. Just last year, Cisco also opened its first manufacturing facility in Chennai, focused on routers with an announced goal of creating 1,200 jobs. Trump loves American brands, some more than others. In the case of McDonald's, which he proudly consumes, and Harley-Davidson, the all-American motorcycle brand that resonates with his voter base and the Made in America ethos, the affection is somewhat clear and visible. Maybe the tariff impact on Indian exports to the US will be harsh in some cases, but that's only if India does not reduce its own tariffs correspondingly. The core believes that this is the right moment for India to cut some of its tariff and make both the country and its industries more globally competitive, almost like the liberalization push of the 90s, though in much smaller measure. Indian industry can rise to the challenge if nudged in the right direction. If Trump's motto is Make America Great Again, then India's motto for now should be Make India Competitive Again. And that brings us to the top stories and themes. The stock markets were up about 3,000 points last week and continue on a strong holding pattern. India's bottom of the pyramid needs more institutionalized investment options, says Kotak Mutual Fund. The rupee is strong and the forex reserves hit a 3-month high. India wants to impose a 12% duty on steel imports. Where could that go? Iraq, the second largest organization of petroleum exporting countries or OPEC oil producer, is to hike output too, suggesting a softening oil outlook ahead.
This is a core report with Govindraj Ethiraj.
The market's on strong holding pattern. Foreign institutional investors are back on the last street, as we've been somewhat carefully pointing out in the last few days. Data has now come in that says they were net buyers on Tuesday and Thursday, buying a little over 4,500 crores worth of stock. Now, the numbers may not be large, but if there is even a slight reversal in sentiment, which it does look like if you were to add up everything else, then it seems to be a good sign for now. Remember, the markets are also rising despite the Trump tariff uncertainty, which suggests the markets are already discounting it or don't care. It's more likely to be the former, by the way, for reasons we've already touched upon. Also, service exports are unlikely to be touched by the tariff war, at least as things stand. And that is where India, thanks to its IT industry and GCC, is well positioned, at least on the medium to long term. Analyst told Business Standard newspaper that there is a sharp decline in FII short positions and increase in long positions in the futures market. Remember, the market started falling in September 2024 when foreign institutional investors started dumping stock. We will, of course, break down those FII numbers and where they're coming from in some detail, but that's later in the week. Last week, the Nifty 50 rose about 4.3% or 953 points to 23,350, while the 30 stock Sensex rose a little over 4% or over 3,000 points to 76,905. This apparently, according to Bloomberg data, was the biggest weekly rally for the key indices since February 2021. Or 4 years. Meanwhile, the index for mid-cap and small caps were also up quite sharply, both between 7 and 8%. And then it was a strong Friday with stocks rising for the fifth day, with the Nifty and Sensex up 0.7% approximately each. Now, well, there is no single number that jumps out. A combination of factors, including a possible interest rate cut on top of easing inflation, is giving analysts a sense that things are turning around, including for companies and businesses and upcoming quarterly results. The rupee is sailing. The rupee ended at 85 rupees 97 paise on Friday after hitting a 10-week high of 85 rupees 93 paise on Friday's session, having gained about 1.2% in the week. Meanwhile, India's foreign exchange reserves have risen by more than $300 million to more than a 3-month high of $654 billion as of March 14th, according to data released on Friday last week. They had risen by about $15 billion in the prior week, the biggest jump since August 2021, according to figures put together by Reuters. More oil supply. We're almost surely headed into a soft oil price scenario as things stand, which will benefit countries like India, with more production increases being announced apart from the United States' own promise that they would drill, baby, drill. The latest is Iraq, which has said it will raise oil production capacity to more than 6 million barrels per day by 2029. Reuters quoted Iraq's oil ministry as saying on Sunday. Iraq is the second largest producer within the Organization of Petroleum Exporting Countries Plus group that includes OPEC and allies like Russia. And it also last month reaffirmed a commitment to the group's output agreement. Iraq said that they will hike output through oil exploration and nationwide drilling activity, including with oil major BP, to redevelop 4 Kirkuk oil and gas fields. Iran's current oil output stands at about 4 million barrels per day, according to government officials there. OPEC had been cutting output by about 5.8 million barrels per day, or about 5.7% or close to 6% of global supply in a series of steps agreed since 2022, but is now beginning, or rather is set to begin, scheduled supply increases in April. Brent crude, meanwhile, has inched up a little and is now quoting around $72 a barrel. India to remove duty on onion exports. In a sign that there is clear or enough supply in the domestic market, India will remove a 20% duty on onion exports starting April 1st, the government said over the weekend. This move follows nearly 5 months of export restrictions, including minimum export prices and bans imposed to ensure domestic availability, according to Reuters. The duty was in effect since September 2024. Targeting the bottom of the pyramid investor. Targeting the saver as opposed to the investor has been a stated objective of many financial services companies in India, particularly in longer term investments like mutual funds. The other side is that the bottom of India's economic pyramid is more exposed and prone to falling prey to Ponzi schemes and usurious interest rate traps and the like. So, could reducing the ticket size of mutual funds be one way to attract such investors, among others, to a more institutionalized market? The 27-year-old Kotak Mahindra Mutual Fund has announced the launch of a Choti SIP facility, literally translated small systematic investment plans for regular investments into mutual funds. I reached out to Nilesh, Shah, Managing Director of Kotak Mutual Fund, who says that there are only 54 million unique investors in mutual funds and thus the opportunity is large. In the Chota SIP, a new investor could begin their wealth creation journey, as he says, with a minimum amount of 250 rupees. There are some other mechanics to the scheme, but I began by asking Shah, a veteran industry man, what was the rationale behind this small ticket scheme?
Govindbhai, we have reached about 5.25 crore investors. To go from here to further, we obviously has to go and service semi-urban and rural India. And from rich and upper middle class, we have to go towards lower middle class and bottom of the pyramid. So one is the business consideration. Second, while equity mutual funds are risky, but it also delivers return and provides financial security if implemented right way. The bottom of the pyramid keeps on losing money in Ponzi schemes, in lottery, in F&O trading, and so many other ways to lose money. These are the people who need financial security. I think we need lower amount so that they can walk into mutual fund, get experience, and then increase more allocation. And second, they can all become part of India growth story.
From a mutual fund or a asset management company, how does the cost of servicing such small accounts pan out? I mean, I would like, for example, a bank today would charge you if you maintain or you're not able to go above a certain amount in terms of minimum balance.
Over here, we are using technology to ensure that our transaction cost is bare minimum. So KYC is done on a concessional basis thanks to SEBI's intervention. The payment is through UPI, which is free. If it was through ECS mandate, the cost would have become prohibitive. Third, we obviously can't reach everyone on a virtual basis. We need foot on the street as well. And they will find it very, very difficult to be remunerated with 250 rupee SIP. So MC has come with an incentive scheme so that they can take additional incentive for popularizing this scheme. The whole objective is to lower transaction cost as much as possible, leverage technology to create distribution reach, and incentivize rightfully the intermediaries so that they can reach out to maximum number of people.
And how would that work out when you start incentivizing intermediaries? Would there be enough left, or is that more like a marketing cost?
So, one, this is coming from the IAP fund, and you have to start an SIP for 250 rupees or more for a 5-year period. And once it is active for 2 years, you will get 500 rupee as an incentive for new to industry customer. So we don't want existing 5 crore investors to start 250 rupee SIP. You already know what mutual fund is. We want to bring new to industry customers, and which is why this incentive is designed for new to industry customer, payable only after 2 years of active SIP and payable for a longer term SIP.
So you talked about 54 million unique investors in mutual funds. Going by everything else in terms of, let's say, the potential sample size or size of potential investors in mutual funds, what would you think is the target that the industry or funds like you could aim for in terms of bringing in new investors and including into the Chota kind of SIP route?
So Govindbhai, we are also venturing into this space for the first time in true format. All along, हमने पानी में खाली हाथ पैर भिगोए हैं, अब बीच भंवर में छलांग मार रहे हैं. So I really don't know what the numbers will be, but we'll keep on learning on this experiment and hope that we have more number of customers over a period of time than what we have today in Choti SIP. This is one instrument which can provide financial security to people, provided it is rightly sold and it is rightly serviced.
So the bet I'm assuming then is that while there is a minimum amount of 250, what you're actually hoping is that people come in at higher levels or progressively go to higher amounts.
Absolutely. Come here, see the experience, and then increase the amount as per your comfort.
Got it. I'm going to come back to the mechanics. If we can talk a little bit about how the markets are right now, of course, you could invest at any point in a mutual fund, and that's a good time. But if you were to be talking to people who want to come in at this point, or you would like them to come in at this point with these kind of size of investments, what would you tell them?
So one, Govind, we are ensuring that only limited products are available for Choti SIP. We have 150 schemes, but not all of them are available for Choti SIP. There is one for conservative investor equity saving scheme, one for average investor a balance advantage fund, one for an aggressive investor an asset allocation fund, and one for general investor a large cap equity fund. Other than these four schemes, we are not launching Choti SIP in other thematic sectoral and small cap, mid cap schemes. Second, our focus is on doing the right communication. So we are leveraging technology for multilingual communication so that we can speak to people in the language which they can understand. The third focus is on working with partners to ensure that they do the right selling and they can do the right servicing, especially if there is volatility in the market. Having said, by building those guardrails, we hope that investors will be long term. And our communication is very simple. You are participating in India growth story, but there will be ups and downs in this journey. Think about volatility first before you invest. Be aware that SIPs could give negative return in a scenario like today. Invest with moderate return expectation. Don't expect last 5 years performance going forward. In a conservative hybrid fund, those returns are of pure equity fund, not conservative hybrid fund. So the whole effort is to ensure that we bring customers with the right messaging. We service them throughout this journey in a manner that they can remain longer term investor. And over a period of time, as their confidence grows, as their comfort grows, they will be able to allocate more money into equity mutual funds.
That's a useful point to pick on. So you said, don't look at what happened in the last 5 years. And what are some of the lessons that we have learned from the last 5 years, particularly in the context of mutual funds and SIPs? Because obviously markets have corrected by maybe 14-15% from peak. But we've also seen a lot of uncertainty or people having second thoughts about SIP investments because they obviously came in almost like a flood in the last 2-3 years. So how are you, or rather, what are the lessons that we can take away from this particular period?
So one, Govind Bhai, quite visible is that people who have come through assisted journey via advisor or distributor, their longevity is much, much higher compared to people who have come on a non-assisted basis, probably looking at just last 6 months, last 1 year's performance. So we have to be very clear that non-assisted segment requires far more support in terms of communication compared to assisted segment. Number two, what we have also seen is that people, who have experience of volatility in the past, their behavior is far more stable. People who have started in recent times post-COVID era, their behavior is more unstable. We need to put more effort in communicating with people who have come after COVID in terms of engagement, in terms of increasing their longevity. We take advantage of technology to find out likely redemption profile of our customers, our investors, and then share it with our partners, further communication. We also communicate with our investors directly to give them support so that they don't end up taking wrong decision at wrong time. Thanks to the word of mouth publicity of our satisfied SIP investors, thanks to the work of partners, the mutual fund Sahi Hai campaign kind of work by MFI, and our communication with our investors, we have been able to ensure that SIP inflows remains fairly strong and the stoppages are reasonably under control.
Right. Nilesh, what are your own takeaways from the market correction that we've seen? I mean, you've seen several corrections and, of course, bounce backs and very strong ones at that. But if you were to look at the correction of the last, let's say, September 2024 to maybe a few days ago, and maybe we are reviving now, what are your personal takeaways?
So one Govind long back in technology media telecom crash, someone had given a comment and I thought that was a guru mantra. नीलेश भाई वो सारी गलतियां आप मत करिए जो मैं खुद कर सकता हूं. Then I don't need you. As a professional fund manager, don't make mistakes which I as a retail investor can do. And that remained with me forever. I think in every correction, that conviction that we have to bet on real businesses and not on make-believe businesses. We have to pay price to earning, but not price to vision. That's so important. And when there was a momentum, our funds were underperforming. At one point of time, our small and mid-cap funds were underperforming benchmark index by 10 percentage point. In that kind of scenario, to give confidence to our fund managers that don't worry, this kind of things have happened in the past. And the ultimate winner is the person who have betted on the right stocks, who have invested in the right stocks. Hand-holding that process, that discipline throughout this journey is the most important factor. It gives so much confidence when during correction, our funds have started outperforming benchmark indices by a margin. Now, many a times investors come and say, 6 months ago, Nilesh भाई हमें लगता था आपकी क्या जरूरत है, बट अब समझ में आ गया है कि आपकी क्या जरूरत है, आपकी क्यों जरूरत है.
If I were to drill down a little bit, so when you say price to earnings versus price to vision, I mean, you're also saying that there are stocks which are fancied by maybe investors, other fund managers, which are not necessarily fundamentally strong. And you too have been tempted, but as I can sense, you've resisted the temptation.
Absolutely. In fact, there are so many low floating stocks where you could ramp up valuation with your own purchase and controlling the floating stock. Your performance will look very, very superior, but that will never be encashable. The day redemption comes and you come to sell those stocks, you will find real value. Now, it's always tempting for fund managers to be superior on performance, ignoring the risk. We, as the CEO or as the CIO, have to provide them that comfort and confidence that let's focus on our long term performance. Let's not take these shortcuts. Let's not go for short term performance. This combination of discipline, investment process, and risk management should differentiate us vis a vis our peers. And I'm so glad we did an analysis of top 50 falls in Nifty 500 some time back. And very few of them appeared in any mutual funds portfolio, not just Kotak Mutual Fund, but any mutual fund portfolio. By and large, mutual fund industry avoided the duds.
If you were to come back to Kotak for a moment and sum up your investment strategy, which incorporates what you've been just telling me as to what to avoid and what to go for, could you walk us through that?
So, first is business. I want to invest in real businesses. Second is management. We want to bet on management who has vision, but who will execute and who will take care of minority shareholder. Governance is far more critical than the capability. And finally, it's the valuation. Price is what you pay, value is what you get. We are neither value investor nor growth investors. We are growth at reasonable price investors. I don't want to overpay. And I also believe that market is not so kind that I will always get an opportunity of underpaying. I'll rather pay fair value and stay with management, which will continue to grow the business. Business management valuation, this is what fund managers look. But as the investment committee, we also have to look at the liquidity and risk management. We also have to look at that our execution happens in the best interest of our investors. And there's no front running, there's no insider trading. So a whole other aspect of investment management is applied at the firm level through risk management policy so that our governance continues to remain good, our execution remains continued to good, and we are showing return which we are capable of delivering in real sense. The liquidity of portfolio is equally important.
I'm going to come to outlook for the market in general in a moment. But you talked about governance and protecting small investors. Is that something that you feel is as live an issue as it was, let's say, 10 years ago or even longer?
Undoubtedly, yes. It's not that we have to be as vigilant as 10 years back, but nevertheless, you have to be vigilant. We are like goalkeeper. We have to be ready for any ball which come to us. And we always should remember that no matter how many goals you save, you will always be remembered for the goals which you allowed to be scored. So your objective as a fund manager is to ensure that all the balls thrown at you, you are able to block. Now, today, pitch is more in the midfield than in your field, but you still have to be careful. You never know. One long kick can come from far and hit the goalpost. We are thankful to SEBI and Ministry of Finance for empowering us. For related party transaction, approval of majority of minority shareholder is the perfect step. It gives us opportunity to make our viewpoint with the management. And there are so many cases in which mutual fund industry has come together to ensure that there is better governance.
Right. And that's a subject that I'd love to engage with you deeper in general, which is governance. Let me come to outlook, Nilesh. So where we are today and where we are headed in the next 2 or 3 quarters, how are things looking in the context of broader economy? Because you are positioning this as a bet on the India growth story. And how are things looking on a slightly more specific level, which is earnings for the next few quarters?
So we will be looking at growth rate which is between 6.5 to 7%, better than September and December 24 growth. Earnings will be between 250 to 275 rupees per quarter for Nifty 50 stocks. And slowly, it should go towards 270 to 280 kind of range. Earnings growth on a lower base of FY25 will be in low double digit in FY26. Of course, there will be stocks and sectors which will deliver higher earnings growth and some which will deliver lower earnings growth. Monsoon should be normal around averages based on the current indication, which is again supportive for our economy. Oil prices should remain soft thanks to the President Trump's policy of drill baby drill. So overall, we are looking at 6.5 to 7% GDP growth for next 1 year and earnings growth in somewhere around low double digit on the lower base of FY25.
Got it. Nilesh, thank you so much for joining me. India wants to raise duties on steel. The Director General of Trade Remedies under the Ministry of Commerce and Industry has recommended a 12% safeguard duty on certain steel products for 200 days to protect domestic steel industry from what it describes as serious injury caused by recent surge in such imports. The recommendation comes amidst concerns of further increases in steel imports following the 25% tariff on steel and aluminum imposed by the United States on March 12th. So steel and aluminum exports to the United States from presumably countries like China and Vietnam are possibly turning around to countries like India. A safeguard duty is a temporary tariff imposed to shield the domestic industry from a sudden surge in imports. Now, the industry, of course, has been campaigning for long for duty increases, even before that tariff increase by the United States kicked into force. And it's also pointed out that factories in China, for example, were producing at cost or only to keep their plants running and thus effectively dumping their steel in India. I reached out to Shankhadeep Mukherjee, Senior Analyst and India Long Products Analyst and Team Leader at Global Metals Mining and Fertilizer Data Tracking firm CRU, and I began by asking him how he was seeing the impact of this potential duty hike.
Now, the key thing to keep in mind over here is that India has a lot of non-tariff barriers, which is the BIS standards that is there. So if you have to import a material into the Indian market, you need to have BIS certification with you. There are some provisions that in case of a critical requirement of a product which is not available domestically, then a NOC could have been obtained and those materials could have been imported even if they lacked the certification. Now, what happened last year, specifically in Q3 of 2024, is that a lot of this provision of NOC was getting misused. And we saw a significant spike of imports of sheet material during that point in time. Subsequently, those NOC issues have, or those compliance burdens have increased and scrutinies have increased as well. But the provision was there and there was some excess imports happening with that.
Right. So when people import hot rolled coils, do they use them as hot rolled coils, or is it for like further conversion to cold rolled or downstream?
I went to the mixture of it. There will be some specific grades they will be buying. So, for example, we don't produce domestically yet the transformer grade products. So that's just an example I'm giving. So we import that from outside. So the non-grain oriented or grain oriented products basically. So some of those are imported. So they are used for the processing. Some of them are used as is, but some of them would be used downstream as well.
Right. Now, we're going to put a 12% import duty and on imported steel. Now, would that apply for all kinds of steel as you understand it? And what could be the implications of this additional duty?
So as of now, I actually see everywhere people are saying we are going to put this in, but it's just a recommendation as of now from the Director General of Trade Remedies that we are going to put a safeguard duty of 12% for a period of 200 days. Now, key thing to keep in mind, this is not a final determination because we now are going to have a 30-day oral hearing period where the industry will give their comments and there will be a public hearing and then there will be a final determination. So that's one of the first things I would highlight. In terms of the impact of this 12% safeguard duty, we are expecting that there will be a partial pass through of this duty on the steel fat products in India because we have been talking about this potential duty for quite some time. So some of this has already been priced in. If it does get implemented from April onwards after the oral hearing and the government then notifies that saying, okay, fine, we'll go ahead with it, then we are expecting around 8 to 10% increase in prices next quarter. There are some potentials which can dilute this pass through though. For example, you might know that over the since last year, 2024, we have commissioned a lot of hot roll coil, hot roll flat steel facilities in India. And because of the weak market conditions, they were ramping up quite slowly. Some support these duties if implemented. Those new capacities will get some support from pricing front and they can ramp up a bit more strongly. But the facility we are tracking around 14 to 15 million tons of additional capacity, which is quite a lot.
You said that we are adding about 14 to 15 million additional tons. So would that take the total figure from 65 to about 80? That's the first question. Secondly, how are you seeing overall trends, including in price, in the context of where economic growth and current overall consumption is in India?
Right. So we will be seeing some growth in demand. So the number I saw of 65 that I gave you, that was demand number, not production number. So we will be seeing some growth, specifically after the Indian government's budget announcement of 2025. We are likely to see a little bit more growth on the flat steel side because of the focus on services and manufacturing more than infrastructure spending. So we will see growth on that front. In terms of production, this is capacity which is coming up, but in terms of production, we don't expect that all of these production will immediately be successful. So it will depend a lot more on how much exports we are able to do. So if I look at our current estimates, we are expecting India to go back to being again a net exporter of flat steel products from 2025. The appetite of demand growth in rest of the world, especially in a tariff world where a lot of tariff investigations being happening everywhere else, the appetite for Indian material is going to be critical in determining how fast the production will grow. We are expecting around 70-ish level by the end of 2025 as far as production is concerned in the domestic market.
Right. Shankhadeep, thank you so much for joining me. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.